Investing is easy. You take your money, buy some shares in companies that you like, wait for some time, maybe buy a few more, and you come out with a profit.
1,000 post-it notes at 12p, and you've made profit.
And the best thing is, it's so easy to do it now, you can literally pull out your phone, sign up for an account and buy a share just in a couple of clicks. So hang on, if it's just that simple and easy, then why doesn't everyone do it? And why do so many people end up losing money with investing? And why do so many people try it for a short period, give up, and never do it again? The answer lies right here. And I'm going to take you on a bit of a journey to show you why this happens, and then more importantly, give you a 5-step process to avoid your head getting in the way of your investing and your future wealth. For the first part of this journey, put your seatbelt on, we're getting in the car and we're off to do the weekly food shop. Around 40 years ago, not very far away from me here in Manchester, the psychologist James Reason wanted to do an experiment to find out the cause of so many traffic accidents. He went to various streets and supermarket car parks and asked drivers about their driving habits. Questions like, had they ever been in the wrong lane before a junction, and do you forget to check your rearview mirror sometimes? Things that will happen all the time, so on average, we'd expect people to say that they also do their fair share of errors. Now, as well as this, the most interesting question that James asked was this one. Rate your driving ability compared to other road users. Are you better or worse than average? In a perfect world, we'd expect some people to say that they're better than average and the rest to say that they're below. That's how an average would work. The results from this study though, well, let's just say were very, very different. Of the 520 drivers that he surveyed, only 5 gave the answer that they were worse than average, meaning that the rest, 99% of drivers, thought that they were better than everyone else. In fact, they not only thought they were a little bit better, many considered themselves a lot better than others. Are drivers in Manchester somehow completely delusional? Or is there something else going on? Well, in the world of psychology, this phenomenon of people thinking that they're somehow above average actually has a name. It's called the better than average effect. Someone in marketing really needs to come up with a better name than that. Now, the reason I brought this up is that this better than average effect comes up almost any time that you ask people how good they are at pretty much anything, whether it's driving, running, working hard, you name it. We all think we're better than average. And tying this back to investing, guess what? We all think we're better than everyone else making money in the stock market too. Do I even need to remind you of what happened in the crazy bull market of 2020 and 2021? The meme stock rally, hype stocks, all of the SPACs and IPOs which people couldn't get enough of. The average person on the street armed with a smartphone who's never traded before was suddenly the expert who just knew that their stocks were only going to keep going up. And while we're at it, forget stocks, what about those other things? Digital tokens with faces of dogs on them? Got to be worth millions, right? Well, we all know how that ended. The point is, our brain tricks us into thinking that we're somehow the star of the show and that we know better than everyone else. It's baked in. In fact, I learned this recently when I listened to this book, The Idiot Brain by Dean Burnett. I'd highly recommend it if you're interested. And one of the big takeaways for me was a reminder that our brain will do anything to puff up our own egos. In one part of the book, we're reminded that our brains will create amazing stories for us about the past that can be completely different from what actually happened. For example, let's say you invested in a random stock because at the time it sounded cool. In a year's time, that stock is now worth 10 times what you paid for it. Rather than just saying you got lucky because you had no idea what you were doing, your brain will tell you that you just knew it was a sure thing and your infinite wisdom needs to be shared with everyone here on YouTube. That's until the stock crashes and then you delete your channel and all your videos. But anyway, the point stands that there are all kinds of biases out there that are built into us as humans which can have a really bad effect on our returns in the stock market. Another one of these psychological biases is called recency bias. Now, other than sounding like a posh hotel, recency bias is the tendency to overemphasize the importance of recent information when trying to predict future events. So for example, in the world of investing, we might look at our favorite stock and say, wow, this went up 100% over the past year because they increased their revenue by 50% this year. I bet it will do the same next year and the year after that.
Not anymore. The verdict! The market's screaming that Peloton is the real deal!
Or on the flip side, let's say the stock market has a bad year, like it did in 2022. Many people out there claim that the biggest stock market crash ever was about to come and that things were definitely going to get worse. They took the most recent data and then projected that out into the future, and again, we all do it, but not everyone is aware of it. The worst outcome for us investors is that we see these amazing returns from some new hotshot fund manager, then pile all of our money in, only then to be let down because they couldn't get the same performance as they did the year before. It seems like it doesn't matter how many times that we're told that past performance is not a reliable indicator for future results, we still, time and time again, chase the latest stocks and funds. Morningstar, the company that rates and tracks different funds, have some great data on this, and we can see how, over time, different funds manage to perform and how long they stay at the top when compared to others. Over long periods of time, just how many funds do you think manage to stay at the top of their game and stay in the top 25% year after year? The answer? Very, very few. For example, let me show you this. Over a 10-year period, here is how many funds manage to stay in the top half of the performance table. So we're not even asking for a top 25% here, just the top half. As you can see, only between 25% and 37% at best manage to keep their top half spot. Diving a bit further into the data, this part is even more interesting. This report shows us how many funds manage to stay in the top 25% by performance after having already done well over the past 3 years. So out of all these high-performing funds, how many manage to stay in the top performing 25% over the following 2 years from December 2020? I can't wait to show you these results. All domestic funds, 0. All large cap funds, 0. All mid cap funds, 0. All small cap funds, just 0.81%, impressive. And all multi-cap funds, 0. Almost none of these hundreds of funds manage to keep up their past 3-year performance and stay at the top, when in fact, wouldn't you expect actively managed funds with all of their data and stock picking ability to do well, especially when the market's down? They should have all of the opportunities to do really, really well, scooping up bargains left, right and centre, and surely they'd have known when to sell everything. These are meant to be the managers who know what they're doing after all. Maybe, just maybe, they're just as flawed as the rest of us. I could go on and on about this topic, and you only have to look at your favourite investing app or platform to see how most of the popular stocks and funds are always the ones that get the most attention from retail investors, the ones that have done well most recently. And this actually leads us nicely to one of our next psychological flaws, the loss aversion bias. Now, I've covered this a few times before on my channel, but this bias is a trait that leads us to feel the loss of something about twice as much as we feel the pleasure of the gain of the same thing. So for example, let's say that you've just bought some shares of your favourite AI stock that's all the rage right now. If that stock price were to double next week, you'd feel pretty good and probably pretty smug. In fact, going back to what we said earlier, you'd probably think that you were a genius and start a YouTube channel telling the world how much you'd made. On the other hand, if that stock dropped in value by half or maybe even a bit more, your feeling of loss would be around twice as much as your feeling of absolute joy. And unfortunately, this feeling of loss works against us as investors. And here's why. FOMO, fear of missing out. The clue is in the name. I think this nicely tells the story of what happened in the stock market in 2020 and 2021 as millions of first-time investors took to the stock market because their friends were making money without lifting a finger. Meme stocks, NFTs, whatever it was, everything went up and it really didn't matter if the company was making a profit or it even existed in real life. It was all just easy money. Now, there's not really a way to fix this part of our human brain, but there is a way to make sure that we're at least aware of it. Some of the greatest investors of our generation have excellent tips to deal with emotions. Warren Buffett famously says that you shouldn't invest into stocks if you aren't willing to hold them for at least 10 years. So reacting to make a purchase just because something's going up is a lousy reason to invest. Another legendary investor, Peter Lynch, reminds us that there's plenty of time to get into a good company and you don't have to be the first investor to make money. In fact, in his book One Up on Wall Street, he talks about the story of Walmart and many, many others where you could have been an investor many years after their IPO and still have made amazing returns. So take it from them, there'll be plenty of other times to invest, and if you get rushed into your investment because of emotions, especially fear, it's time to step back and just wait a moment. One last thing worth touching on is another one that probably will never go away, but one that we just need to manage. Greed.
Greed is right. Greed works.
As well as being something that apparently is really good for money managers and great if you need to put on loads of weight like Augusta's glute, it's not so good if you want to manage long-term wealth. I think just like we make terrible decisions when we're hungry, making investment decisions because we think we can get some short-term gains only ends up getting us into some serious trouble. There's loads of stories throughout history that can teach us the lesson to not be greedy, but one that springs to mind is this one from the great book, The Psychology of Money. Before the Great Depression in the 1930s, a stock market trader called Jesse Livermore made one of the best trades of all time by shorting the stock market, therefore betting that things were about to go down right before the crash that kicked off the Great Depression. According to the story, he made over $100 million during that time, which based on today's money would have given him a fortune of $1.6 billion. At that point, you would have thought he'd be set for life, go and relax somewhere, enjoy your life, and even spending millions a year, he'll never run out. Sadly, that didn't happen. Unfortunately, Jesse never set back and he took his fortune and started making bigger and bigger bets on the stock market until eventually he had nothing left. Overtaken by greed and a sense that he knew everything about how the market worked, he ended up taking his own life rather than being able to enjoy the money that he'd made in those incredible trades. Sadly, we do this to ourselves all the time in the stock market, and it comes in cycles as we enter new bull markets or someone comes along promising to change the world with an absolute sure thing. Let me tell you now, there's no such thing. And if someone promises a guaranteed return to you and they have a surname like Ponzi, that's your opportunity to say, thanks, but no thanks. Okay, so I did promise you I'd summarize everything up with this 5-step plan to avoid some of the biggest flaws that we have as humans. We can't change who we are, and arguably we need a lot of these traits for survival, but we can at least manage them and recognize when the caveman part of our brain takes over. So here goes. First up, detach your investments from your emotions. This is a lot easier said than done, but one thing I would definitely say is that if you can automate your investing as much as possible, then you get to remove at least one factor from the mix. If you can treat investing just like paying your phone bill every month, do it no matter what, consistently, over a long period of time, you're very likely to do extremely well. Obviously, this is really for index fund investing and passive investing. If you want to pick your stocks, then you're going to have to make things a little bit more complicated, but you still might find it useful to just set and forget, and over time you'll just get used to doing it. Sometimes you'll buy during market high, sometimes during right at the bottom, but either way you'll end up getting the market average, which is more than most people end up getting in return. Secondly, invest only what you can afford to lock away for a long time. If you can do this, and this is another way to remove your emotions from investing, and it stops you making reactions based on the fear of loss. As we know, all long-term investors are going to have to go through periods of stock market crashes and corrections and probably spend a lot of time in the red at some point. If we get nervous or panic during those times, we'll risk giving up and never investing again. And we'll probably buy back in only when things are looking good and going up again. This is a surefire way to lose money and lower your return. So just invest what you can without putting yourself in any financial difficulty, which actually leads us nicely onto point 3. Have access to the good old emergency fund, spare cash, credit cards, whatever it is. Personally, I don't really care, but you have to have some kind of cash available to you that can prevent you from selling your investments. Nothing's worse for a long-term investor than having to sell out and losing all of that future years of compounding growth. And as Charlie Munger says, don't interrupt compounding unnecessarily. Some people say 3 months worth of cash, some people say 6 or even 12 months. Personally, this one's up to you, but at least give yourself some kind of buffer because, as we all know, life happens, whether it's car tires, leaking roofs, or even unexpected tax bills, it's just a matter of time, so have that cash ready. Okay, point 4. You need to stop looking at the day-to-day movements of the stock market. I'm going to sound like a hypocrite here because I'm guilty of this, but then I am trying to run a personal finance and investing channel. The key thing is not letting any of those daily and short-term movements actually change your behaviours. Now, if you are the kind of person who likes to make impulsive decisions and you know this is the case, then you're just going to have to remove these trading apps from your phone or do something like that to stop yourself. As we've seen in the earlier parts of the video, making short-term trades and reacting to the market out of fear and other emotions only leads us down a pretty rubbish path where we lose all our money. So pay attention if you're interested, but don't let it change your investing style. And that nicely links to the final point where I'm saying you should find a style of investing that works for you, works for your level of risk, and will let you sleep at night. This one's the ultimate test. If your investing is keeping you up at night or making you worried throughout the day, you could be taking too much risk for you. You might not even know what kind of level of risk you're happy with until you take them, but once you find this out, change things around until you're feeling better, and then the rest of the plan just needs to be a long-term one to let everything else take care of itself. So for me personally, I've worked out that I like the majority of my investing to be in passive, low-cost index funds, and then I'll give myself a smaller percentage, which I think right now is around 20%, where I can pick some individual stocks or other kinds of investments. I can tell you that I don't spend any time worrying about my investments. Instead, I just worry about whether anyone will actually enjoy watching my videos instead. Now, if you've made it this far, please do me a huge favor, hit the like button, but also comment the word FOMO below. I'd love to see how many make it to the end, and don't forget to subscribe if you aren't already. Anyway, I'll leave you with this next video. See you in the next one, and as always, happy investing.